Hello, everybody. Welcome. This is take 2 of Intermediate Accounting 17th edition of video solution walkthrough. Kiso, Weingart, and Warfield problem 19.3. This is from the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingart, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. Wiley, all rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Let's get to it. So right over here, we've got problem 19.3. And let's just kind of digest this just for a little bit. So right over here, we've got second year of depreciation difference. And prior to 2020, taxable income and pre-tax financial income were identical. So that's important. So right over here, pre-tax financial income is 1.7 million in 2020. And it is 1.4 million in 2021. I'm going to skip number 3 for just a second, and let's go to number 4. Interest of $60,000 was earned in 2021 on tax-exempt municipal obligations. So over here, so in 2021, there was $60,000 of revenue here that I included for financial statement purposes. But this is a permanent difference, and this $60,000 is not going to be taxable. Now over here for number 5, we had a gain in discontinued operations. Now we're not going to deal with that just quite yet, but when it comes to going through over here, and this is eBay, when we have discontinued operations, if you remember going back to chapter 4 on this, what we have to go through and do is to show that income after continuing operations, but we're going to be showing that net of tax. So let's come back over here. Now let's get to the fun part, which is going to be the depreciation. So on January 1st, equipment costing 1.2 million is purchased. It is to be depreciated on a straight line basis over 5 years for tax and 8 years for financial reporting. Let's do the financial reporting first. So over here for financial reporting, basically I had over here 1.2 million minus 0 salvage value, I'm going to assume, divided by 8. And this is going to give me $150,000. So every single year for financial statement reporting purposes for the next 8 years, or from 2020 through 2027, I'm going to take a total of 1.2 million in depreciation. Now, this part over here, it's talking about the half-year convention. And basically what this really means is that you're going to do it straight line, but you're going to only take a half year in, let's just write this out. So we got 1.2 million. And this is going to be divided by 5. So my annual depreciation for tax purposes is going to be $240,000 per year. But what this half-year convention is referring to is in the first year of tax depreciation, I'm only going to be taking 50% of that amount. What happens in the next few years is I'm going to go ahead and take the full amount. And then in the last year, I'm going to go ahead and take the remaining half. So it is 5 years, but it's kind of funky, but it's just the way that the Kiso textbook is having us look at this. So, but again, that's what the solution says, and we're just going to run with that. So the reason why I did this is that when we look at 2020, and if I isolate 2020 right over here, I'm taking more depreciation for financial statement purposes than for tax purposes. So over here, I have a temporary difference, basically, of depreciation expense for 2020. And this is going to be, I'm going to do an add back of 30,000, right? Why am I doing an add back? Because I deducted 150,000 over here for financial statement purposes, but for tax purposes, according to this half year convention, I'm only taking half of the full year amount. So over here, this is going to be an add back. And this is why this is such probably the most important step of the problem. So over here, I've got 30,000, right? Basically my difference between book and tax. Now, if I go take a look at this, so the remaining depreciation I'm going to be taking for my books is going to be $1,050,000, right? So right over here, if I take these items right over here, this is going to be $1,050,000. For basically for book purpose, so for tax purposes, my remaining deductions are going to be right over here of $1,080,000. So what we can kind of go through and see with this is that, okay, is that over here, if I kind of use the same part, this 30,000 is going to be reversing in future periods. If I look at this right over here, and then I've got this one here. So in future periods, my financial statements, I'm only going to be deducting $1,050,000, but for tax purposes, I'm going to be deducting $1,080,000. So the reason why this is so important is that because I'm paying for the taxes now, this will be an add back. This is going to create a deferred tax asset for 2020. So when I take 30,000 times 0.2, I'm going to get a deferred tax asset as of 12/31/20. And this is going to be for $6,000. And this is what's going to be on my books. Now, deferred tax asset, this is going to stay with me, right? I'm not going to be going through and getting rid of this. This is an asset account. It is sitting on my books. Now, what happens with this deferred tax asset is the following year on 1/1/21, this amount over here is going to go ahead and carry forward. So again, we're looking over here at 2020, a very, very important thing is happening. As a result of what's going on over here, we are creating a deferred tax asset because I'm paying more because I'm only able to deduct 120,000 for tax purposes. I deducted for financial statement purposes 150. So this is creating a $30,000 temporary difference, which is going to reverse out in future periods. Okay, now we're ready to go through and look at 2021. So let's take a look at 2021. So when I look at 2021, and this over here, so in the 2021 year, what's going to be happening here? Well, over here, my difference is actually now going to be a negative 90,000. So I'm taking 240 for tax purposes, but I only took 150 for financial statement purposes. So what I'm going to be able to go through and do is I'm going to be able to take another $90,000 deduction. So in terms of my taxable income, what is my taxable income going to be? And again, we're talking about current taxable income. I'm not going to deal with the deferred yet. We'll deal with that momentarily. So over here, my taxable income is going to be 1.4 million less the permanent difference for the tax exempt interest for 60,000, less because I'm taking more depreciation for tax purposes than I am for book purposes. And this is going to give me 1,250,000. At this point in time, I'm going to take my tax rate My tax rate is going to be 20%. So my income taxes current is going to be over here at $250,000. So what we're going to go ahead and do is we're going to say 12/31/21, because what I'm being asked to do, compute taxable income and income taxes payable for 2021. And this is what it is right over here. So what I'm going to do here is I'm going to have my income tax expense current. This is going to be 250,000. I'm going to have income taxes payable current of $250,000. Okay. Now what we're going to go through and do is look at, well, what should our deferred tax liability be for this? Let's take a look at that. So as I'm going through and now looking at these future periods, right? So if I'm going to go up here and let's come up with a new color. We'll go ahead and use the real stuff. We'll go a little Bruin magic right over here. All these kids love that school. I feel sorry for them. If you're there at UCLA, my thoughts and prayers. Okay. And one thing I did make a mistake on, this should be 2022. Okay. So over here, I'm going to be taking future deductions for financial statement purposes of 900,000. But for tax purposes, right over here, I'm going to be taking future deductions of 840,000. Okay, so right over here, this is going to create a deferred tax liability of $60,000. Okay, so future, I'm going to have over here, I'll have deductions of 900,000, but for tax purposes, I will only have 840. So I'm going to have over here a deferred tax liability of $60,000. Okay, so I know that my ending balance here for 12/31/21 is going to be $60,000, right? So, but what am I going to have to do to get there? I'm going to be crediting this over here for 60,000. Okay. So now that I've gone through and I've done that, the next question is, do I still have this deferred tax asset anymore? And the answer is going to be no. This is now going down to zero. So what am I going to need to do with this? I'm going to have to go through here and credit it, because this has gone through and reversed out. This is what I'm going to have to go through and do. I'm going to go ahead and credit the deferred tax asset. Now, if you've been watching my other videos, I am very deliberate with how I go through and record these transactions. The first thing I'm going to go through and do is I'm going to handle the income tax expense current, income tax payable current. It's the first thing I do. I then go through and look at my liability. I look at my tax asset. In this scenario here, I had a carryover of 6,000 from the prior period. However, this is no longer viable. And there's one other thing I just totally screwed up on. What's the problem with what I just did over here? This is not my deferred tax liability. These are the actual deductions I'm going through and making. This is going to be 20% of this amount, or $12,000. So my deferred tax liability, kids, and I want to apologize for this, is going to be 12,000. Wow, I'm an idiot. But we all make mistakes. And I'm not going to redo this video for a third time. Okay, so right over here. So my deferred tax liability right over here is going to be 12,000. What did I forget to do? I forgot to multiply it by the amount of the tax rate. Over here, I have a deferred tax asset. I had to get rid of that as 6,000. Remember, over here, it was an asset as of last year, but that's no longer the case. So I have to remove that from my books. Okay, so what do I need to do to balance? Well, over here, I have 268,000. And over here, I only have 250. So I'm going to need another 18,000. We're going to call this income tax expense deferred. Okay. Fun stuff. Okay. So that's what we're going through and doing. And just give me one moment. So again, as you'll see here, when the book is showing you the solution, they're combining income tax expense into one amount. On the other hand, what am I going through and doing? I am breaking it out between deferred and current. The actual amount of the income tax expense is in fact 268,000, but I'm choosing to break it out like this, and it's really going to be for the next part that we're going to be going through and taking a look at. So we've dealt with letter B. Now, what we have to go through and do is to say, prepare the bottom portion of the income statement, beginning with income from continuing operations before income taxes. So my income from continuing operations before income taxes is going to be how much? Well, that amount is not going to be 1.4 million. Why? Because included in the 2021 pre-tax financial income is a gain on discontinued operations, which is fully taxable. So what I'm going to do here is my income from continuing operations before income taxes is going to be 1.4 million minus 200,000. Okay. Now, when it comes to this next part over here, is that when we go through and look at the income tax expense deferred, that's not really going to go through and change. So my income tax expense deferred is going to be 18,000. That's not going to change. But my income tax expense current is going to be a little bit different. Just give me one moment. Okay, so my income tax expense current, that amount right over here is going to be 250,000. What I'm going to do though, is I'm going to go ahead and say, well, if my income tax expense current is 250,000, this includes the taxes that relate to this 200,000 on the disposal. So what I'm going to do is to isolate this is my gain on disposal. The taxes on the gain on disposal is going to be 200,000 times 20% or $40,000. So my income tax expense on my current year, basically on continuing operations, is going to be 210,000. So my income tax expense current is going to be 210. And so my income from continuing operations, this is really after tax, is going to be 1.2 million minus 18 minus 210, or 972,000. Now, going back over here to our eBay example, what I now need to show is the income from discontinued operations, but net of income taxes. So what I'm going to do over here is I'm basically going to say, all right, so income from discontinued net of tax. Okay, so this is going to be what? This is going to be 200,000 minus 40,000 or 160,000. So the total amount over here of my net income is going to be the 972 plus the income from discontinued operations of 1,132,000. To make sure we did this correctly, let's just do a quick check. If I take my taxable income of 1,250,000, and then I go through over here and I take out my income taxes, just give me a moment. So just to do a quick check, my pre-tax income of 1.4 million, right, before any kind of adjustments, less my income tax expense. And this would basically be both the deferred and minus also that current portion, is going to basically give me my net income of 1,132,000. But when I go through and show this, I have to go through and show it this way, because over here, this is how I need to go through and disclose it. So as far as how deferred income taxes should be presented on the December 31st, 2021 balance sheet, what you would want to go through and do is to perhaps, well, let's actually check. Hold on. So in terms of our presentation for right over here, how should deferred income taxes be presented on the December 31st, 2021 balance sheet? You would just have over here, you would have a deferred tax liability of $12,000. The deferred tax asset was eliminated. However, what I do want to share with you, though, is that when it comes to going through and doing and looking at income taxes, you are going to be going through and you want to be, there is going to more than likely be schedules that you're going to have to go through and show. So again, as you're doing this, I want you to really make sure that you're going through and looking at examples from publicly traded companies. Very, very important to do. So in any event, I want to thank you for joining me here today. I'm sorry that the video is like a little bit rough, but I think for like as all of us, deferred income taxes is something we're all trying to explore together. But I really want to thank Wiley for allowing me to go through and to use their videos, assuming to use their questions for these videos. And I look forward to seeing you on the next video. Have a great day.